All right, so ICT just released his last lecture on YouTube, and it is 1 hour long. And in that lecture, he teaches the market maker model on how he trades it. Now, it is a different approach, and I'm going to explain each and everything in this video. The original video is 1 hour long, but I'll try to make it as quick as possible and in as much detail as possible. Right, so let's get started because this video is going to be really interesting. So number one step is we need to know whether we are bearish or bullish. Now there are multiple ways to know that. You can use my external and internal liquidity method, or you can just look at the order flow. So we are going to be using 3 time frames for this. Okay, ICT didn't specifically mention this, but this is the right way to approach this model, if that makes sense. So the very first step, we need to identify whether we are bearish or bullish. So on your highest time frame, you would be looking at the order flow. Are we going down or are we going up? If we are going down, then we simply have to identify buy side liquidity. So over here, you can see we have relative equal highs. We have a high here and we have a high here. Now, instead of relative equal highs, we can also have a swing high here. Both work, okay? It just have to be a liquidity point. Now, the next step is that you have to look for a fair value gap or another PDA rate, could be a auto block, but I would say just look for fair value gaps because that works the best. Okay, and I would personally only look for fair value gaps. Now you have to look for an inefficiency or you can say fair value gap above the liquidity level. So this is a buy side liquidity and this is the fair value gap. Okay, once you have that, you are anticipating that price is going to take out the liquidity, which is here, equal highs, right? And it will also fill in the sell side imbalance, buy side inefficiency, if that makes sense. SIBI, right? So price will fill out this fair value gap as well. You are anticipating this at the moment, okay? Now, if I zoom in a bit like that, you have to look for the last low and the high. So price goes into the fair value gap. Now, once price goes into the fair value gap, you have to look for the last low that was formed on your highest time frame. Okay, and I will get into that later in the video. So the last low on your highest time frame. Now inside this low, we have to identify original consolidation. Okay, so we will be then dropping to lower time frames. So let's say that I was looking at this price action on the daily time frame. Once price goes into the daily time frame fair value gap, right, I will mark out the low on the daily time frame, of course, and then to identify the lower time frame market maker model, which would be the consolidation phases and then accumulation phase 1, accumulation phase 2, right? I will drop down to 1 hour time frame. Okay, we go from daily to 1 hour to 5 minutes to take our entries. So I will drop down to 1 hour time frame and I will look to identify original consolidation, a consolidation phase around here. Now that would be our target. But if you can anticipate, and now this requires a higher skill level. Now, once you identify the original consolidation and you have the buy side liquidity here, right? You will be anticipating that price will take out these equal highs and it will also go into this fair value gap. Now, this is also how you can trade this model. So once price gets out of the consolidation, so let's say there is a consolidation here, right? Price gets out of the consolidation, you can look to take your entry on the retest of the consolidation, knowing that price will take out the buy side liquidity and will fill out the fair value gap. Okay, you can also trade this. Now this can go up, right? You can also enter on the accumulation phase 1 or accumulation phase 2 until the fair value gap is hit. But this is not how I would prefer to trade. ICT said you can do it, well and good. You can try it out. If it works for you, well and good. The point here is that we have to trade this leg, okay? And we have to identify the market maker model inside here near this low. Okay, that is the point. So once price goes into your highest time frame, the highest time frame fair value gap, simply drop down to 1 hour time frame. Now identify the market maker model on the 1 hour time frame. Once you have that, right, you can also drop down to 30 minutes time frame. Okay, if you do not see a clean consolidation, but not lower than 30 minutes. Now, you have to look for then a market structure shift, okay, that supports that price will now go into this level. Once you get a 1 hour market structure, so there's gonna be a low here, price breaks that low, right? You can then simply take your low risk entry from here. Now, to go to the third time frame, which is going to be our lowest time frame. Now, this is very optional, okay? You can do this to improve your win rate. What you can do is you can look for a PD array that is formed inside this 1 hour leg. So on the 1 hour time frame, we got a market structure shift. Now you have a 1 hour fair value gap above here. Once price goes into that level, you look for another market structure shift on the 5 minute time frame. So in this example, we would go from daily to 1 hour to 5 minute time frame to take our entry. But remember, we can take our entry directly from the 1 hour time frame. We do not need to go to the third time frame, which is going to be the 5 minute time frame. Now, this is going to be your low risk entry. Okay, this is where you can look to take your entry, but the best entry that you will get. So let me just remove this, guys. The best entry that you would get is on the second distribution leg. So look for a break of structure. Once you have a break of structure, right, you can simply just look to take your entry from the fair value gap. And now this entry is gonna just rush towards your take profit level, because this is the second distribution, also known as the silver bullet of the market maker model. You will take your entry, and of course you can then drop down to 5 minute time frame, look for another market structure shift to even confirm that price will head towards this level, or just simply directly enter off this level. Okay, you can simply enter off this level and target the original consolidation low. Very simple, guys. Very, very simple. So let me repeat this again, and then we will move on to the example. So first off, identify the order flow. If the order flow is bearish, identify buy side liquidity. It could be a swing high or could be relative equal highs. Now, once price goes in, and then you have to, of course, then identify a fair value gap above your buy side liquidity, right? Once you have identified the fair value gap, you are anticipating that price will now go into this fair value gap and also take out the buy side liquidity. Now, once price goes into that fair value gap, look for the last low that was formed on your highest time frame. So that is going to be the daily time frame. Now, this applies to every single time frame. Time is fractal. So you can basically start with 1 hour time frame, then go to 5 minute time frame and drop even lower to 30 seconds time frame to take your entries. Okay, time is fractal, remember that. So now once you have identified the original consolidation, you can try and you can experiment. You can try taking your entries by targeting these equal highs, right? So you would first off take your consolidation breakout trade. You will take your entry on the retest of the consolidation. Then you can take your entry from the accumulation phase 1, accumulation phase 2 until price reaches this fair value gap. Once price reaches the fair value gap, you are looking for a smart money reversal or a market structure shift, and you can take your low risk entry from there, which is going to be this fair value gap. After that, to take your second distribution entry, you would look for a break of structure, and here you would get a break of structure. Now, once price comes into this fair value gap or an auto block, right, you can simply look to target the low of the original consolidation. It's going to look something like this. So let's move to the examples, and then I will end the video. And my apologies, I couldn't connect the camera today because I'm a little bit sick, but don't worry, I'll get back to it later in the later videos. All right, everyone. So here is example number 1. I'm looking at NZD JPY, and I can see a fair value gap here. And the order flow is clearly bullish, right? So we also have this swing low. I could say relative equal lows with this over here. And we have this last high. So I'm going to mark this out just for the reference. Now price goes into this fair value gap. Once that happens, I will drop down to 1 hour time frame. Now I have to identify the original consolidation, and I can clearly see an original consolidation phase just around here. Remember, bodies tell the story. So what we have here is that in this range, price was struggling to go up or down, and this is called original consolidation. Now, as I said before, you could have taken your entry after price broke out of the consolidation range on the retest, targeting the fair value gap. But we want to take this move. All right, so just around here, we got our market structure shift. With the candle close here, this is the high. And we have this auto block here, consecutive bearish candles. And we got our entry here. I would simply go long just here, put my stop right below this low here. And I would target the high of the consolidation range. Now price went up, but it came back way down, but it never violated this low. This example is not perfect, but the thing is, trading is not supposed to be perfect. You're going to have scenarios like this. That's why I'm showing you an example that is not perfect. We didn't violate this low, but price eventually went up and took out the high of the consolidation range. This would have given you 2.5 risk to reward if you didn't go break even. So that's it for this example. I mean, you could have taken your entry from this auto block and you wouldn't have been close on break even. But if you're not a break even trader, this would have been a very nice winner. And once you have these rules, you can get into the trade with full confidence. So yeah, let's move on to the next example now. All right, guys, so here is another example. So the order flow is clearly bearish. So we simply identify buy side liquidity. So in this case, we have equal highs, and above the equal highs, we have this fair value gap, or you could say PD array. It doesn't necessarily always have to be fair value gap, could be a auto block, but I prefer the fair value gaps. So we have this low, the last low, right? We want to mark this out for reference, but then when we drop down to 1 hour time frame, we have to look for original consolidation. And by using the bodies here, I can see a consolidation phase. It doesn't always have to be a perfect consolidation, but you can see price failed to go above this level. It tried the third time actually here, but then price went down to this range and failed to go below that. So price consolidated here. Then, as I said before, price broke out of the consolidation range. You could have taken your entry here. Then we had the accumulation phase 1. Could have taken your entry from this auto block. Then we had a break of structure, right? And then we have this auto block here. Actually didn't get an entry here. Could have been an entry from this, but yeah, but then price went into the fair value gap. We had a break of structure here, or a market structure shift, as you can say. Remember my market structure shift video. This is also one way to identify market structure shift. And there was no actually real entry point here. I would have skipped it, but then we had this beautiful break of structure once again, and we had this fair value gap, and price tapped into this fair value gap and it just went down. So beautiful delivery. Price filled in this fair value gap here as well, and it just went ahead and took out the last low that was here. So thank you so much for watching, guys. I highly suggest that you watch ICT video. I explained some of it in my own terms, and the way I find it, like, I would say, never mind, just go and watch ICT video if you can, but this should be enough for you to understand what he explained in his last lecture. So yeah, guys, thank you so much for watching. And one last thing, this is a promo about my course. If you are interested, for just $97, you can get access to my course plus private Discord server where I share my own trades. And I have like everything that ICT has taught before simplified into 5 to 10 minute long videos. I'll see you guys in the next video. Goodbye.